Okay, so let's be real. If you're not already invested in the stock market, you're missing out big time. Now, if you would have invested about 5 years ago or even just 1 year ago, you would be much more wealthier than you are right now. But since you can't invest 5 years ago and you can't invest 1 year ago, the next best thing is to invest right now. And that's what I'm here to show you guys how to do. Hello everybody, my name is Tyson. Welcome to the channel. So happy to see you guys here. And today we're going to be going over how to invest in the stock market for beginners. And I'm going to be taking you guys through step by step how to invest start to finish, as well as how to make some good investments. So we're going to be going over in this video what a stock is, how to purchase a stock, how to analyze stocks, and what type of stock investing is best for you. Now look, there are lots of other videos on YouTube about how to get started in the stock market for beginners, but the only problem is all of those videos are like 20 minutes, 30 minutes, up to an hour long. Look guys, to get started in the stock market, you don't need to know everything about stocks, okay? You just need to know the nitty gritty, the bare bones, that's it. And that's what I'm gonna be going over in this video for you guys today. I'm gonna keep it short, sweet, and concise, because time is money, and I'm not wasting you guys' time, and I'm definitely not wasting your guys' money. All right, so let's cut the chit chat and get right into the video. Okay, so what is a stock? Basically, a stock is just a little tiny portion of a company. So if you own one stock, you own a little bit of that company, and if you own 100 stocks, then you own more of that company. Still probably just a little bit, but you're gonna own more than if you just have one stock. Now the stock price is actually driven by supply and demand. So if a company comes out with some really good news, or like they're gonna advance into a different sector, or their earnings report was really good, or the projections are really good, that demand is gonna go up and the supply is gonna go down, and that's gonna drive the price up. Now on the other hand, if they come out with some really bad news or something bad happens, their earnings reports didn't meet their projections, then that stock price is going to be driven down because the demand for that stock is going to be going down because people don't like where the stock is going, and the supply is going to go way up. The price is just going to go right down to the ground. So in the most basic terms, that's what a stock is. Okay, so now I'm going to be going through how to invest in a stock. So in order to invest in a stock, you need to do it through a brokerage account. So this brokerage account can be hosted by a bank like TD Ameritrade, or also like online brokers, also known as discount brokers. You can go with whatever you like, but in my opinion, it's kind of a no-brainer. The banks are gonna charge you a lot more fees and stuff than the online brokers will. That's why they're called discount brokers. So a lot of the online brokers, they'll charge you maybe $5 a trade. A lot of them actually don't charge you anything a trade. They're pretty much free, the ones like Robinhood basically. And then with a bank, they're gonna charge you like $10 per trade, and they're gonna take a big fat commission fee off of all the capital gains that you get. So in my opinion, I would definitely go with an online broker. Some that I suggest are like in the US, they have like Webull and Robinhood. I heard those ones are good. I've never used them personally because I'm from Canada. But here in Canada, we have Wealth Trade, Simple, and we also have Questrade. Now, I'm with Questrade, so that's the one that I personally recommend because, you know, I'm with them. But Wealthsimple is also really good. But I mean, with brokers, you can't really go wrong because, I mean, we're talking pennies here. You know, the difference between $5 a trade and $10 a trade. It's not really a huge deal, but it's just something to think about, and it's not a big deal which one you decide to go with. So now I'm gonna be showing you guys how to analyze a stock. Now, analyzing a stock can actually be pretty time consuming, and learning how to do it can be pretty time consuming as well. But there is such a thing as passive investing, which is like you don't really have to go through and analyze the stocks yourself. I'll explain it more later in the video. But if you want to actively invest and you want to analyze stocks, we're just gonna keep it simple here because I'm trying to show you guys just the most simple ways to invest. So fundamental analysis is basically made up of two parts: qualitative analysis and quantitative analysis. Now, qualitative analysis is basically everything that can't be quantified. It's everything that can't be put into a number. So the business's leadership, for example, is a business run by a bunch of monkeys on unicycles, or is their CEO one of the greatest minds to ever bless the world of business? You know, that's going to affect the actual stock, or what competition is in the sector, or, you know, things like that, things that can't be put into a number. Now, quantitative analysis is everything that can be put into a number, everything that you can quantify. So their earnings reports. So for this, you're gonna want to look at, you know, their balance sheet, their assets, their liabilities, You're gonna wanna look at their ratios, like the PE ratio, and there's a bunch of different types of ratios. I'm not gonna get into everything in this video, but those are the types of things that you can look at in order to analyze a stock. And lastly, but certainly not least, I'm going to tell you guys what type of stocks that you should personally be investing in. Now, if you're young like me, you're going to want to invest with a little bit more risk, just because you're probably not playing with that much money, and you can take more risks as you're young. If you're a little bit older, or you want to invest in like your retirement, or you don't want to take quite as much risk, so for that, you're gonna want to invest in like the really big established companies, or you might want to invest in like an index fund or an ETF. Now, an index fund or an ETF is basically like a basket of stocks. If you buy one stock of an index fund, then you're basically going to buy a small percentage of whatever is in that index fund. So the S&P 500, for example, is the top 500 stocks trading on the US stock market right now. So if you were to invest in just one stock of the S&P 500, you'd be buying a little bit of Apple, a little bit of Google, a little bit of Facebook. So if one of those companies actually tanks, it's not really going to hurt the overall price of that stock. So it's really low risk, but your returns aren't going to be that much either. So there's not that much room to grow if you're already one of the top companies in the world. Your stock isn't going to like double over a year or even a couple of years, because you're already so big. So for it to double, that would take a lot. But on the other hand, if you're looking to get more risk but a lot more reward, you can invest in smaller companies. Now, for these, you can look at market cap. What market cap is basically how much a company is worth. So if it has a small market cap, then it's a small company. If it has a big market cap, then it's a big company. If you invest in a small market cap company, then you have a lot more potential for growth, because they're already a small company. So it wouldn't be that outlandish for them to double or even quadruple. But the thing is, since they're such a small company, they're less established than these bigger companies. So they can go bankrupt or basically just go underwater a lot easier than these huge companies can. So me personally, I'm invested in some really big companies like Apple, but I'm also invested in some really small companies. So I'm invested in big companies because I know I'm going to be making money on the stocks. Even if the company takes a big dip, I know that they're going to go up again in the long term. So that's why I'm invested in the big companies. I'm also invested in the small companies because there's a lot of potential for growth. And while it is a bit risky, I'm not putting all of my money into the smaller companies, so I'm not risking it all. I'm kind of risking half my money and not risking the other half of my money. So in the long term, I get some good gains from both the big companies as well as the small companies. So that's how I personally like to do it. You can do it however you want. If you don't want to risk your money at all, you can just only invest in like the bigger companies. And if you're feeling a little bit risky because maybe you're young, or maybe YOLO, you can invest in the small companies if you want as well. So there you go. That's everything you need to get started investing in stocks. So if you guys are interested in learning more about the stock market and how to make better investments, I actually have a video coming out in a couple of days about stock market tips for beginners. So make sure you subscribe and hit the bell if you want to see that video coming out. And as always, thanks so much for watching. I really appreciate it. Please give the video a like if you learned anything, or if you liked it throughout any point. And as always, I'll catch you guys on the next one. See you later. I'm good with that.